If you haven't invested before and are looking to start, well, this video will be in great interest in yours. You may have been told that the stock market is very risky and you'll probably lose all your money and it's the end of the world. If I would earn $1 for every time I heard that. Majority of the people that say this, they've lost a lot of money. And what most of them do or did is that they would buy into a stock that's rallying based on FOMO because the stock is going high, and they would buy high, and once the market crashes, they would sell low. And bam, right there, you just lost a lot of money. And that right there is not called investing. That is called speculating or gambling. Us investors, we like to look at financial statements and we like to see what the company's doing, then dip our toes in it. The stock market is risky, but only for those that have no idea what they're doing. To invest in stocks, as I mentioned earlier, you must be looking at financial statements. You must believe in the industry, and you must be keeping up with the company. See what they're doing, what the update is, the management. You have to be looking at all these things. Overall, when you are buying a stock, you're buying a piece of a company. For instance, let's say down the street from you, there's a mama and papa pizza shop, and you are interested in buying that shop. Obviously, what you're going to do is do research on it, saying, if the location is good, if the business is good, if it's generating cash flow, what does it have, what's its liabilities, do they own debt, do they not own debt, do they have customers, do they don't have customers, what is the pizza market, and you would look at all that. And you would obviously look at the price of what they're selling. Same exact rules apply when you are buying the stock. But let's say you don't want to look at financial statements, nor do you want to see what the company is up to, simply because you don't have time. Well then, ETFs are the right investment for you. ETF, or exchange traded funds, are diversified index funds where you can purchase many companies rather than buying individual stocks. Pretty much your eggs will not be in one basket. These types of investments have less risk, big potential, and diversification. So now that we briefly covered what ETFs are and why they're a good place to start investing, here are 2 Canadian stocks to buy right now for the next 10, 15, 20, 30, 40 years. All right, let's get started. But before we do, I have to make a note here so I don't get in trouble. I am not a financial advisor. I'm just a guy on YouTube that talks about calories, nutrition, and fitness that happen to have a lot of experience in the investment field. So any calls or any investment that you guys do, please do your research first. And if you're a new viewer, welcome to the Nature Boy Fitness channel or the Pidgey channel. And here we talk about calories, nutrition, fitness, and alongside with the new series, investments. So if you guys like these videos, give that thumbs up a big smash and letting me know that you guys enjoy this video. Also, don't forget to hit the subscribe button and the notification bell so you guys are notified when my video drops. All right, let's put on my investment glasses and let's begin. A wise man once told me that if you invest in the S&P 500 index, and constantly contribute on a monthly basis, over time, you will become super rich. The first ETF that we're going to be talking about is based on the S&P 500 index. What is the S&P 500 index fund? It's pretty much the 500 biggest and the largest US companies. Companies like Amazon, Microsoft, Apple, Facebook, and soon to be Tesla are or is already a part of this index fund. Meaning that if you participate in any ETF that follows and participates in the S&P 500, then you own a small piece of those companies. There are many ETFs out there, but I don't see many YouTubers talking about this particular one. The ticker symbol is xsp.to, or iShares S&P 500 Index Fund. This is a Canadian ETF that focuses on the S&P 500 in the US, which is quite convenient for Canadians because we don't have to exchange our weak Canadian dollars for that almighty American dollars. So we can save a bit. As of July 31st, which is a Friday, the ETF was trading at $35.55. And if we look at the past 5 years, it is growing very steadily. The PE ratio of the trading 12 months is 4.35, which is cheap. xsp.to also provides 1.88% of dividends. But take good note of the expense ratio. The expense ratio is a certain ratio that the company will charge you for handling your investment. But don't worry, it's nothing that you will pay out of your own pocket. The expense ratio of xsp.to is 0.09%, which is not bad at all. We can also see more details if you guys go to Yahoo and type in xsp.to. We can see the top 10 biggest holdings of this ETF once we click on holdings. And you can tell it changes from time to time, but relatively you can see it how they prioritize the ETF or the fund. Regarding financial statements, guess what? There is none to look at. because it's an ETF. So you don't have to worry about looking at income statement, balance sheets, or cash flow statements. And if you guys are worried that maybe 1 or 2 or 3 or 4 or 5 companies out of the 500 companies might go bankrupt, and you may think this may impact the fund and may go lower or plunge, well, don't worry guys, they have 495 other companies to fall back on. And right now in the S&P 500, something interesting is happening where the tech stock is pretty much moving everything up. So right now, as long as tech is doing very good, the stock will continue to do very good. I personally own the stock and I do contribute on a monthly basis so I can get that sweet compound effect in the next 10, 20, 30, 40 years. And if you guys are still skeptical of the S&P 500, let me show you some facts. The S&P 500 has a rate of return of 9.8% on an annual basis. For an example, if you bought one share of the S&P 500 in the 1980s, which is about 120 bucks, without doing any contributions, you would now have $3,200 today. But if you did contribute, let's say 500 bucks on a monthly basis, from 1980 till now, you would now have $2.6 million or $2.7 million, given the annual rate is still 10%. $2.7 million. I mean, that's retirement right there. I mean, we don't have to work another day in our lives again if that's the case. So that's the power of the S&P 500 and the compounding effect. The second ETF that I don't see many YouTubers talking about is the ticker symbol zeb.to, or BMO Equal Weight Banks Funds. The Canadian banks are a strong backbone to the Canadian economy. So investing in this sector is probably one of the smartest investments that you guys can do for the long run. But the problem is which bank is a better bank to invest in and which one has a better competitive advantage? Well, if we look at the Canadian banks one by one, they all have their purpose. And judging by how Canada is a young country and people are still immigrating to it, we can expect the population to grow. And when the population to grow, there's expansion. When there's expansion, they need to borrow money. And when they borrow money from the banks, there's interest to be paid. But don't forget, banks, their product is money. So I think you know where I'm going with this. We can expect that the Canadian banks will continue to grow at a very good rate. But which one will perform the best and which one will perform the worst? We can only predict this by looking at their financial statements, by looking at their mission and visions, and looking deep into the company, seeing what their activities are, and so on and so forth. But we don't want to do that here, in this video, at least. So the best choice here is to invest in all of them in just one trade. If we go ahead and look at the ETF, as of July 31st, the ETF is trading at $24.09. And if we look at the past 5 years, we can see it's growing steadily and nicely. But at the moment, because we had that big crash in March, we have a 20% discount from its all-time high. I mean guys, 24 bucks compared to the Canadian bank stocks right now, I think it's a good deal. The current PE ratio is at 9.88, making this ETF fairly cheap. This ETF also gives out a monthly dividend at a yield of 4.92% on an annual basis, but also a whopping 0.55% on expense ratio, which is kind of high for an ETF, but I believe this is a very quality ETF stock to buy, and there's a price for it to pay. And not to mention here, the price appreciation here is going to be very well and very strong in the coming years, because again, Canadian banks are a backbone of the Canadian economy next to energy sector. So we can see that the growth of all banks, I mean, it's going to happen. We can also see what banks they own the most in Canada by percentage by checking on Yahoo when you type in their ticker symbol and clicking on holdings. It clearly tells you what percentage they own at a given time. Like right now they own a majority of it to National Bank, but that's going to change later on in the future depending on which bank is in a better spot to grow. I personally own this ETF as well, and I do contribute on a monthly basis so I can get that sweet compounding effect interest in the future. And there you have it guys. These are two Canadian ETFs that I believe they're kind of undervalued and they have a lot of room to grow. Personally, I don't like to put a lot of my money in my savings account because, I mean, what percentage does the bank give you really? They give you a maximum 2% to go with inflation, and that's if you're lucky. So putting your money in these ETFs has a lot less risk and a more potential room to grow. So if you guys have learned something new, comment down below. If you guys have any questions, still comment below. I will be more than happy to answer it. If you guys really enjoyed this video, because I know you guys did, hit that like button so it can help me and I can make more of these videos. And obviously, subscribe for more, and I shall see you guys in the next video. Peace.